Why billionaires are turning to non-traditional assets. The financial world tends to focus on high-visibility assets, gold, Bitcoin, blue-chip stocks, commercial real estate. These are the instruments discussed on mainstream media, debated on financial news networks, and circulated in public discourse. Yet, the wealthiest individuals on the planet rarely follow public conversation. Instead, they quietly reposition their portfolios into assets that the general investing population seldom notices or does not understand. The shift is not merely speculative. It represents a deeper philosophy that sees wealth not as a number, but as control, security, and insulation from systemic risk. This foundational idea explains why billionaires are increasingly acquiring obscure assets that serve strategic rather than purely financial purposes. What distinguishes billionaires from traditional investors is not only their access to capital, but their access to information. Their decisions are informed by long-term global forecasting, geopolitical analysis, environmental modeling, and macroeconomic data unavailable to the average investor. When one observes the kinds of assets they accumulate, the pattern reveals what they fear and what they believe will matter in the decades ahead. This is why the video emphasizes that billionaires are moving into obscure assets whose value derives not from hype cycles or speculative demand, but from their connection to fundamental human necessities: food, water, and safety. These are the pillars of civilization, and thus the ultimate stores of value. The first motivation behind this quiet acquisition trend is hedging against systemic instability. Traditional assets are deeply entangled with market psychology, government policies, interest rate movements, and global liquidity cycles. Stocks may crash, currencies may inflate, and even commodities can fluctuate sharply. In contrast, assets tied directly to survival needs are able to land. Water access, risk transfer, instruments retain value, regardless of financial volatility. In fact, their value often increases when traditional markets suffer. This asymmetry makes them attractive to individuals who wish to preserve wealth across multiple generations. The second motivation is control of scarce resources. Wealthy individuals understand that as global populations rise and environmental pressures intensify, demand for essential resources will outpace supply. Owning land with dependable water access, securing senior water rights, or participating in catastrophe bonds is not merely an investment, it is a way to position oneself advantageously in a world where scarcity could become the dominant economic force. This explains why certain billionaires, including agricultural and technology magnates, have rapidly expanded their holdings in farmland and water-adjacent regions. Third, billionaires increasingly invest according to a thesis of decorrelation seeking. Assets whose performance does not track stock indices or macroeconomic cycles, catastrophe bonds, for example, may deliver high yields simply because their outcomes are tied to natural disaster frequencies rather than market sentiment. Farmland generates cash flow, independent of interest rate decisions or equity volatility. Water rights appreciate when drought conditions intensify, regardless of broader economic conditions. This quality makes these assets powerful tools for preserving and multiplying wealth under uncertain conditions. The trend also reflects a psychological dimension. The wealthy think generationally, not quarterly. They look toward 2050 and beyond, considering challenges such as climate change, diminishing freshwater supply, geopolitical fragmentation, and increased natural disaster frequency. Their investments reflect foresight rather than short-term opportunity. The fact that they are accumulating these assets quietly without large public announcements suggests they recognize the strategic sensitivity of these sectors. Public attention could raise prices or provoke regulatory intervention, so silence becomes part of the strategy. Finally, billionaires gravitate toward these obscure assets because they provide tangible power. Ownership of essential resources translates directly into influence. Controlling farmland means influencing food supply chains. Holding water rights means having priority access in periods of drought. Participating in catastrophe insurance markets means gaining exposure to a sector likely to expand dramatically as climate events escalate. While digital assets and equities can evaporate in a market crisis, these obscure assets hold their ground. Thus, the shift toward farmland, water rights, and catastrophe bonds is not random. It is a deliberate reallocation into assets that align with the long-term realities of a changing planet. These investments reveal what billionaires perceive as the future economic battlegrounds: access to fertile land, controllable water inputs, and adaptive financial instruments capable of absorbing rising environmental volatility. Understanding this shift is not merely informative, is a window into how the elite prepare for global transformations long before they become visible to the general public. Farmland, the strategic asset behind quiet billionaire purchases. Farmland has emerged as one of the most quietly accumulated assets among billionaires, and this trend reflects a complex combination of economic reasoning, environmental foresight, and strategic long-range planning. While the average investor tends to view farmland as an illiquid and unglamorous investment, the global elite see it as one of the most essential, resilient, and underappreciated stores of value available today. The video highlights that one of the largest private owners of farmland in the United States is Bill Gates, who controls more than 200,000 acres. This data point is often misunderstood or dismissed as an eccentric obsession. Yet it reveals deeper truths about why fertile land is becoming increasingly coveted by wealthy individuals and institutional investors. To understand why farmland has become such a magnet for billionaire wealth, one must revisit the fundamental role it plays in civilization. Every economy, regardless of technological advancement, ultimately relies on a stable supply of food. Digital assets, financial derivatives, and speculative markets may come and go, but the need for agricultural production is constant and non-negotiable. In a world of rising population, climate volatility, and disrupted supply chains, farmland is not just real estate, it is a cornerstone of survival. When billionaires buy farmland, they are not simply making a financial trade. They are purchasing a form of long-term relevance and influence. Another reason billionaires gravitate toward farmland is its resilience against macroeconomic instability. Unlike real estate tied to consumer demand or equities tied to earnings cycles, farmland maintains its intrinsic value because agricultural products remain essential regardless of market fluctuations. Food demand does not decline in a recession. In fact, it tends to rise. Certain farmland even appreciates faster during economic crises because global uncertainty pushes investors toward hard assets. This countercyclical behavior is exactly what ultra-wealthy individuals seek when constructing portfolios capable of withstanding extreme volatility. Farmland also offers multiple layers of value creation, which is unusual among physical assets. First, it can generate steady rental income if leased to farmers or agricultural companies. Second, it can appreciate in value, particularly in regions with favorable climate conditions or strong access to water. Third, it can produce commodities, such as grains, fruits, or livestock, that generate stable cash flow. Fourth, it can benefit from subsidies, tax incentives, and agricultural support programs. These overlapping revenue streams provide a combination of growth and protection that few conventional asset classes can match. However, billionaires do not purchase farmland indiscriminately. The video emphasizes that the most coveted parcels share certain characteristics that dramatically elevate their long-term strategic value. These include fertile soil, reliable water sources, access to aquifer systems, proximity to distribution infrastructure, and climate resilience. Not all farmland has equal potential. In fact, much of it may face declining productivity due to drought, desertification, or water scarcity. Therefore, the elite concentrate on prime agricultural zones, regions capable of maintaining or increasing output even under environmental stress. The strategic importance of water access cannot be overstated. In many regions, farmland is valuable only if it includes senior water rights, priority pumping access, or proximity to sustainable irrigation sources. Billionaires understand that future agricultural productivity will depend heavily on the ability to secure dependable water supply. As climate change intensifies, rainfall patterns become unpredictable, and groundwater levels drop. Land with guaranteed water access could become exponentially more valuable. Because of this, the purchase of farmland is often indirectly a purchase of water security. Another overlooked factor driving billionaire interest in farmland is geopolitical instability. Many nations rely heavily on imported food, and disruptions, such as pandemics, wars, or shipping bottlenecks can expose vulnerabilities in global food supply chains. By owning farmland, Wealthy individuals can either directly participate in food production or control assets that will appreciate as global supply constraints tighten. Farmland becomes a hedge not just against inflation or recession, but against systemic disruptions driven by geopolitical conflict. Furthermore, farmland offers an attractive hedge against currency devaluation. Unlike fiat currencies, which can be inflated by government policies, farmland is a finite resource. The supply can't be expanded, and high-quality farmland is even more scarce. This scarcity gives it the same appeal as precious metals, but with the added advantage of generating ongoing economic output. In periods of inflation, food prices tend to rise faster than other essentials, increasing profitability for farmland owners. A growing concern among billionaire investors is food security, not just for themselves, but as a global macroeconomic force. Ownership of productive land allows one to influence or benefit from the most basic economic flows. While average consumers may think of food shortages as temporary events, elites consider them long-term structural risks. They recognize that the combination of population growth, environmental degradation, and declining arable land per capita will inevitably make farmland a more contested and valuable asset. Finally, billionaire interest in farmland reflects a broader move toward tangible, essential assets. In contrast to high-volatility speculative investments, farmland is physical, productive, and deeply tied to human survival. It does not rely on digital infrastructure, does not disappear in market crashes, and does not require a functioning financial system to retain value. For this reason, farmland has quietly become one of the foundational components of wealth preservation strategies among the global elite. Water rights. The invisible power asset billionaires are accumulating among all the obscure assets discussed in the video. Water rights stand out as the most underappreciated, yet arguably the most strategically significant. While the public often focuses on land purchases or financial investments, the wealthiest individuals increasingly recognize that water, not oil, not gold, not Bitcoin, may become the most valuable and contested resource of the 21st century. Water is indispensable for agriculture, energy production, sanitation, manufacturing, and human life itself. Yet access to clean, reliable fresh water is decreasing globally due to overuse, pollution, climate change, and demographic expansion. Billionaires are paying attention to this trend long before it becomes a mainstream concern. To understand water rights, one must first acknowledge how different they are from land ownership. In many regions, especially in the western United States, water rights are legally separated from the land they sit on. This means one can own a plot of land without any guaranteed access to water, or, conversely, hold legal permission to extract, use, or divert water without owning the surrounding land. This concept is foreign to most everyday investors, yet it is central to the strategies of the wealthy. The video highlights that billionaires prioritize assets with senior water rights, meaning they have priority access to water, even during droughts or shortages. These rights can be extraordinarily valuable because they effectively grant control over a resource that becomes scarcer every year. The shift toward water rights is driven by two intersecting forces, increasing scarcity and rising demand. Freshwater supplies are under severe stress worldwide. Aquifers are being depleted faster than they can recharge. Snowpack levels in key regions are declining. Rainfall patterns are becoming less predictable. At the same time, agriculture responsible for roughly 70% of global freshwater consumption must support larger populations and greater food production. Industrial demand is also growing, with water-intensive sectors like energy, semiconductors, and manufacturing expanding rapidly. This imbalance between declining supply and intensifying demand makes water rights an asset with explosive long-term potential. Billionaires understand that controlling water is not merely a financial maneuver, it is a direct path to influence. Water availability determines which regions remain productive, which industries thrive, and which communities grow or decline. In drought-prone areas, senior water rights can effectively determine the economic viability of entire agricultural zones. This gives holders of these rights disproportionate power, especially during periods of environmental stress. Water becomes not just a resource, but a form of leverage. And in an era of climate-driven uncertainty, Leverage over essential resources is a form of strategic dominance. Another reason wealthy investors accumulate water rights is the expectation that water will become a geopolitical flashpoint. Historically, societies have fought wars over land, oil, and borders. But as freshwater scarcity intensifies, tensions over water sources, rivers, aquifers, reservoirs are likely to rise. Countries that rely on shared rivers may face conflicts during droughts. Regions without access to sustainable water supplies may see population displacement, economic decline, or political instability. Billionaires view water rights as a hedge against these global disruptions. If water becomes the defining resource of the future, those who control it will hold a decisive position in the global hierarchy of power. Financial motivations also play a significant role. As water scarcity increases, the economic value of senior water rights is expected to rise sharply. In some regions, these rights already trade for 6- or 7-figure sums, depending on their reliability and proximity to agricultural or industrial centers. Unlike many speculative assets, water rights have a built-in demand curve. Humans cannot reduce water consumption below a certain threshold. Industries cannot operate without significant water input. Agriculture cannot function at all without irrigation. This structural demand makes water rights one of the few assets with guaranteed long-term utility. Furthermore, water rights are attractive because they are often uncorrelated with traditional financial markets. Stock prices may fluctuate based on earnings reports or macroeconomic cycles. But water scarcity is driven by environmental and demographic realities. This lack of correlation creates a unique diversification opportunity for high-net-worth individuals seeking resilience in their portfolios. As a result, water rights behave not only as a commodity, but also as a risk hedge against inflation, recession, and systemic market shocks. The strategic significance of water rights becomes even clearer when viewed through the lens of climate change. As droughts become more frequent and severe, regions with ample water will become economic hubs, while water-stressed areas may lose value. Farmland without secure water access will decline in productivity and valuation. Entire supply chains may shift based on water availability. Billionaires investing in water rights are effectively betting on climate-driven redistribution, value across geographic regions. They are positioning themselves to benefit from or protect themselves against the reshaping of global agricultural and industrial landscapes. Another dimension of this trend is the privatization of water infrastructure. Some billionaires and private equity firms have begun investing in water utilities, desalination plants, wastewater treatment facilities. These investments further consolidate control over water distribution. While this trend raises ethical questions, it is consistent with the overall strategy. Those who understand the future importance of water aim to own not just the rights to extract it, but the systems required to transport and process it. Ultimately, quiet accumulation of water rights reflects a broader understanding among billionaires that essential resources, those tied directly to human survival, are the most enduring and powerful investments. Water is irreplaceable, non-substitutable, and increasingly scarce. This combination makes it not only a vital humanitarian concern, but also a dominant economic force. While the public debates gold and cryptocurrency, the global elite are securing control of the one resource capable of influencing the fate of nations. Their actions signal a profound shift in the hierarchy of value, one that places water at the center of long-term power and wealth preservation strategies. Catastrophe bonds, the high-yield asset built on global crisis. Catastrophe bonds, commonly called cat bonds, represent one of the most unusual and least understood financial instruments that billionaires are increasingly investing in. Unlike stocks, real estate, or precious metals, CAT bonds derive value from a counterintuitive premise. They perform well precisely because they are tied to risks that traditional financial markets cannot price efficiently. The rise in global natural disasters driven by climate change, urban expansion into high-risk areas, and escalating reconstruction costs has created an environment in which these bonds have become not merely exotic assets, but essential tools for risk transfer within the global insurance and reinsurance sectors. Billionaires and institutional investors recognize this trend, and their growing involvement reveals a sophisticated understanding of modern risk dynamics. To understand the appeal of cat bonds, one must grasp their fundamental structure. A catastrophe bond is issued by an insurance company, a reinsurance firm, or a specialized risk transfer entity seeking protection against massive losses from specific disaster scenarios, such as hurricanes, earthquakes, floods, or wildfires. Investors who purchase these bonds agree to shoulder part of the risk. In exchange, they receive unusually high interest payments, often far above market rates. If the specified disaster does not occur within the bond's term, the investor receives their principal back, along with a generous yield. If the disaster does occur, the insurer uses the bond's principal to cover claims, and the investor loses part or all of their investment. This binary structure makes cat bonds fundamentally different from conventional debt instruments, as their risk is tied to physical events rather than financial performance. The key attraction is non-correlation. The behavior of cat bonds is almost entirely independent of stock markets, interest rate environments, geopolitical tensions, or currency fluctuations. They do not rise or fall because of earning reports or economic cycles. Their value is linked solely to the probability and severity of natural disasters. This makes them extremely valuable for wealthy individuals seeking assets that retain stability during economic crises. When traditional portfolios decline due to recessions or market crashes, cat bonds can continue generating returns. This unique insulation from financial volatility is one of the primary reasons billionaires quietly allocate capital into this sector. Another reason is the increasing frequency and cost of natural disasters. As climate change intensifies, catastrophic events are becoming more common and more destructive. Hurricanes are larger, wildfires spread faster, flood zones are expanding, and extreme weather events are occurring outside historical patterns. Insurance companies face growing liabilities that threaten their operating stability. Cat bonds help distribute this risk across a broader investor base. The more disasters occur globally, the more insurance premiums rise, and the more attractive cat bond yields become. Thus, billionaires are not merely chasing high returns. They are investing based on the expectation that environmental volatility will continue to escalate. The rapid growth of the catastrophe bond market in recent years underscores this shift. What was once a niche financial product has evolved into a multi-billion-dollar sector, drawing significant interest from hedge funds, sovereign wealth funds, pension funds, and private investors. The appeal lies not only in yield, but also in the fact that cat bonds provide exposure to an industry insurance that grows as global risk increases. In a paradoxical sense, the worse climate events become, the more valuable these financial instruments may turn out to be. Billionaires understand this relationship and quietly accumulate cat bonds as part of broader strategies designed to profit from or hedge against climate instability. Another significant factor is the transparency of risk models used in cat bond pricing. While equities and corporate bonds rely on opaque balance sheets, earnings assumptions, and accounting practices, cat bonds are governed by probabilistic models built by climatologists, geologists, and risk analysts. These models estimate the likelihood of specific disaster scenarios based on decades of environmental data. Although they are not perfect, they provide a level of clarity and scientific grounding that some investors consider more reliable than corporate financial projections. Billionaires appreciate investments where risk can be modeled mathematically rather than emotionally or politically. Moreover, cat bonds offer wealthy investors the opportunity to diversify into a rapidly expanding asset class that is simply inaccessible to most retail investors. The minimum investment for many cat bonds is extremely high, and participation often requires entering specialized insurance-linked securities markets. This exclusivity creates a barrier to entry that suits billionaire investors seeking opportunities uncorrelated with mainstream investment behavior. While the public focuses on stocks and cryptocurrencies, the elite quietly leverage instruments unavailable to ordinary investors. There is also an ethical dimension to catastrophe bonds that appeals to certain billionaire philanthropists. Some view cat bonds as a way to indirectly support disaster relief by providing insurance companies with the capital necessary to cover massive claims. By absorbing some of the financial risk, investors help ensure that communities affected by disasters receive faster, more reliable payouts. Although profit remains the primary motivation, the dual nature of financial return and social impact adds an additional layer of attractiveness for investors with philanthropic objectives. However, The rising popularity of cat bonds is not without controversy. Critics argue that investors are effectively profiting from human suffering, as payouts correlate with the absence of disasters while losses materialize when devastating events occur. Others worry that an increasing dependence on private investors could lead to distorted incentives or excessive financialization of essential risk transfer mechanisms. Yet, from the perspective of billionaire investors, these concerns do not overshadow the bond's financial appeal. The harsh reality is that in a world transformed by climate volatility, instruments that price and transfer catastrophic risk will become increasingly central to the global financial system. Ultimately, cat bonds represent a unique convergence of climate reality, financial engineering, and strategic hedging. Billionaires who invest in them are not simply chasing yield, they are positioning themselves for a future in which environmental volatility becomes a dominant economic force. Cat bonds offer a rare combination: high returns, portfolio diversification, scientific risk modeling, and independence from traditional market cycles. This alignment of factors explains why they have become a key component in the obscure asset strategies of the global elite. While the public debates inflation, interest rates, and cryptocurrency trends, billionaires are quietly profiting from one of the most powerful macro forces shaping the next century: the rising cost of natural disasters. Why these assets are quietly preferred over gold, Bitcoin, and traditional markets for decades. Investors seeking safety have gravitated toward gold, government bonds, blue-chip stocks, and more recently, digital assets like Bitcoin. These instruments dominate the public imagination as reliable hedges against inflation, market downturns, and economic instability. Yet paradoxically, the wealthiest individuals are increasingly shifting away from these mainstream safe haven assets and reallocating capital toward obscure, less publicized investments such as farmland, water rights, and catastrophe bonds. This strategic departure is not accidental. It reflects a fundamentally different understanding of risk, value, and long-term resilience, one that separates billionaire investment behavior from conventional financial wisdom. To understand this divergence, one must first examine the limitations of the traditional assets that retail investors often rely upon. Gold, for instance, has historically been viewed as a universal store of value. However, it is ultimately a passive asset that produces no cash flow and offers no strategic leverage. Its value depends largely on investor sentiment and macroeconomic fears. While gold performs well during market distress, its long-term returns are modest. Billionaires, who aim to compound wealth over generations, prefer assets that generate consistent output, yield, or influence. Farmland produces crops. Water rights provide critical access to essential resources. Cat bonds generate high returns uncorrelated with equity markets. Gold simply sits in a vault. Bitcoin and other cryptocurrencies face a different problem: extreme volatility and uncertain regulation. Although crypto assets can produce extraordinary short-term gains, they can just as easily experience catastrophic declines. Their value is largely speculative, driven by narratives, hype cycles, and market liquidity. For billionaires managing multi-billion-dollar portfolios, volatility is not a feature, but a liability. Additionally, cryptocurrencies depend on a functioning digital infrastructure and regulatory environment. Farmland, water rights, and cat bonds, by contrast, remain valuable regardless of political, digital, or monetary systems. The elite prefer assets whose utility is grounded in physical reality, not digital consensus. Traditional real estate, a favored investment among middle and upper middle class investors, also shows structural weaknesses when viewed through a billionaire's lens. Urban and suburban properties depend on local economic conditions, interest rates, and population trends. They are susceptible to cycles, bubbles, and regulatory shifts. In contrast, farmland's value is tied to food production, a global necessity independent of local economic cycles. Similarly, water rights appreciate based on scarcity, a universal driver unaffected by consumer sentiment. Real estate is fundamentally a human-driven market, while these obscure assets are nature-driven. Billionaires are increasingly choosing investments governed not by markets but by physical laws, Another major reason billionaires prefer obscure assets is control. Gold and Bitcoin cannot be controlled, improved, or enhanced. They simply exist. Stocks grant partial ownership of companies, but do not confer control unless accumulated in massive quantities. Farmland, however, can be improved through cultivation, soil restoration, crop selection, and technological upgrades. Water rights grant direct power over a region's resource allocation. Cat bonds allow investors to participate in global risk transfer systems, effectively positioning themselves as insurers of last resort. Control is a crucial factor in billionaire strategies because control enables influence, and influence, in turn, compounds wealth. In addition to control, billionaires value asymmetrical protection assets that remain resilient under multiple future scenarios. Gold protects against monetary instability, but offers little defense against climate disruptions. Bitcoin may hedge inflation, but collapses during liquidity shortages. Stocks can surge during economic expansions, but falter during recessions. Farmland protects against supply chain disruptions, inflation, food shortages, and geopolitical instability. Water rights protect against drought, environmental stress, and scarcity. Cat bonds protect against market downturns because their risk lies outside the financial system. These obscure assets act like multi-dimensional hedges, safeguarding wealth across climate, economic, and political risk layers simultaneously. Another differentiating factor is the visibility of the investment. Billionaires understand that publicized assets become overpriced as retail and institutional demand pours in. The more people talk about Bitcoin, gold, or tech stocks, the less attractive they become for the elite, who prefer undervalued, less crowded investments. Obscure assets remain insulated from speculative mania. Their pricing reflects fundamentals rather than hype. This privacy advantage also helps billionaires avoid drawing attention to their strategic moves. If the public fully understood the long-term significance of water rights or prime farmland, prices would skyrocket and governments might intervene. Quiet accumulation allows billionaires to secure these assets before broader awareness reshapes the market. Another reason for this preference is generational planning. Billionaires think not in election cycles or decades, but in centuries. Their portfolios are designed to outlast technological disruptions, political regimes, monetary resets, and social transformations. What remains valuable over centuries? Land that grows food, water that sustains life, instruments that price and distribute risk as global conditions evolve. Gold may endure, but it does not grow, reproduce, or influence. Bitcoin may endure, but it depends on electricity, computational consensus, and an elaborate global network. Farmland and water rights, however, remain valuable regardless of societal complexity. Inflation dynamics also play a role. Traditional assets like bonds lose value during inflationary periods, while stocks may suffer from rising rates. Gold protects purchasing power, but offers no income. Farmland and water rights, by contrast, benefit directly from inflation because food and water prices rise faster than general inflation indices. Cat bonds also tend to offer higher yields when inflation rises, because insurance premiums increase in response to higher replacement costs. These assets not only preserve wealth during inflation, they often outperform. Finally, billionaire preference for obscure assets reflects a deeper philosophical understanding. The future of wealth will be determined not by financial engineering alone, but by access to scarcity, essentials, and resilience. The world is entering an era where climate volatility, resource shortages, and systemic instability will reshape how value is created and preserved. Gold, Bitcoin, and traditional markets offer limited protection in a structurally changing world. Farmland, water rights, and cat bonds align directly with the forces defining the future. The future implications. What these investments reveal about the next global wealth shift. The quiet accumulation of farmland. Water rights and catastrophe bonds by billionaires is more than an investment trend, it is a revealing signal about the future configuration of global wealth, power, and economic stability. These asset choices indicate that the world's most influential individuals are preparing for structural changes that may redefine how societies function and how prosperity is preserved. Understanding the implications of this shift provides insight into emerging economic realities and the trajectory of global systems in the coming decades. The first major implication is the revaluation of essential resources. For centuries, financial markets have prioritized industries that scale rapidly: technology, finance, manufacturing, and energy. But the growing billionaire focus on land and water suggests that the global economy may be entering an era where physical constraints overshadow technological innovation. Advances in software cannot create rainfall. Artificial intelligence cannot replenish aquifers. Blockchain cannot manufacture fertile soil. As physical scarcity intensifies, resources that address fundamental human needs will command increasing power and value. The elite are positioning themselves accordingly, anticipating that these assets will become more influential than many traditional industries. A second implication is the potential consolidation of resource control. When billionaires accumulate farmland and water rights, they are not simply diversifying portfolios. They are centralizing ownership of critical inputs that communities depend on. This trend could reshape power dynamics within nations and across borders. As water scarcity grows and food systems come under stress, those who control the underlying resources may achieve disproportionate influence over production networks, pricing, and distribution. This consolidation could exacerbate inequality, as access to food and water becomes increasingly tied to private ownership rather than public infrastructure or communal management. The growing investment in catastrophe bonds signals another significant shift: the monetization of climate risk. As natural disasters intensify, the cost of rebuilding communities will strain public finances and insurance companies. Cat bonds transfer the burden onto private investors, effectively transforming climate volatility into an investable asset class. This shift implies that the future financial system may incorporate climate risk as a foundational component, similar in importance to interest rates or currency fluctuations. Billionaires who invest early in this sector may stand to benefit from the expanding market for climate-linked financial instruments. Positioning themselves as key players in a rapidly growing industry, these investment patterns also reveal a deeper recognition among billionaires that traditional financial systems may become less reliable. The global economy faces numerous vulnerabilities: debt overload, demographic pressures, geopolitical fragmentation, cyber threats, supply chain disruptions, and resource shortages. While retail investors cling to conventional safe havens, the elite are constructing portfolios designed to withstand systemic breakdowns. Farmland provides food security, water rights, ensures survival in drought conditions. Cat bonds protect capital from market-driven crises. Together, these assets form a multi-dimensional defense against the kinds of structural shocks that could destabilize economies worldwide. Another implication is the geographical redistribution of value. Regions with fertile soil, abundant water, and climate resilience will rise in importance, while areas facing chronic drought, declining soil fertility, or extreme weather may experience economic decline. This shift will influence migration patterns, political stability, and investment flows. Countries that can manage water resources effectively will become global power centers, while those vulnerable to environmental stress may struggle to maintain growth. The strategic acquisitions by billionaires are early indicators of this emerging geographic reshaping. The quiet nature of these investments highlights a critical point: the public is not meant to notice. If average investors understood the long-term potential of water rights or climate-linked bonds, demand would soar and prices would escalate. Governments might intervene to protect strategic resources. By acting discreetly, billionaires can accumulate these high-value assets before they become widely recognized. This secrecy further reinforces the divide between elite and public financial knowledge, suggesting that the next major wealth shift may be driven not by innovation or speculation, but by early access to resource-based assets. There is also a profound implication for social stability. As essential resources become privatized and financialized, tensions may arise between public needs and private ownership. The concentration of farmland and water rights in billionaire hands could spark debates over resource sovereignty, environmental justice, and equitable access. The rise of cat bonds, meanwhile, could shift disaster recovery toward market-based mechanisms. raising concerns about the ethics of profiting from catastrophe, even as these instruments provide critical liquidity to insurance systems. From an economic perspective, these investments reveal an anticipation that inflationary pressures may persist long-term. Food, water, and reconstruction costs are inherently inflationary, especially under conditions of scarcity. By investing in assets linked to rising real-world costs, billionaires are effectively hedging against a future where inflation is structural rather than cyclical. This suggests a belief that monetary policy alone cannot solve emerging problems rooted in physical constraints. Perhaps the most profound implication is the recognition of a new hierarchy of value emerging globally. For decades, financial assets dominated wealth-building strategies. Today, the elite increasingly prioritize assets grounded in the real-world land, water, and climate-linked instruments. These investments indicate that the future of wealth will be shaped not by digital speculation or financial engineering, but by the ability to secure essential resources, manage environmental risk, and withstand global instability. In sum, the billionaire shift toward obscure assets signals a broader transformation in how the world, as most informed individuals perceive the future. They are not betting on technology alone to solve planetary challenges. They are preparing for a world defined by scarcity, climate volatility, and resource-driven power structures.
Oh,
Their investment behaviors offer a blueprint for the next era of global wealth, one where control of essential resources supersedes conventional assets and where resilience becomes more valuable than growth. Understanding these implications is crucial for anticipating the economic and societal shifts that will shape the coming decades.